Hey, 20 years ago, the IRS has given us the best gift possible in regards to our retirement savings. But still 70% of you, that's right, 70% of you are still not taking advantage of it. Do you know what it is? Stick around. We will fill you in on absolutely the best way to save for retirement. Welcome to the show, everyone. I'm Joe Anderson, certified financial planner, president of Pure Financial Advisors. I'm with the big man. He's Big Al Clopine. He's sitting right over there. He's going to break down a lot of different strategies for us today to have a very comfortable and tax-free retirement. What I'm talking about is the Roth IRA, folks. The Roth IRA was enacted in 1997, 20 years ago, that allows us to have tax-free growth and then tax-free income in retirement. Is it right for you? That's today's Financial Focus. All right, here's the stats, folks. Look at this. 29% of you have a Roth IRA. What are you doing? Get out of bed. Open up this account ASAP. It allows tax-free growth. Let me repeat that. 100% tax-free growth. There is $24 trillion in retirement accounts today. $24 trillion. Most of those dollars are in the standard 401k plans, IRAs, 403bs, and every last dollar that comes out of those is taxed at ordinary income. There's huge amounts of money. Look at this stat. Only 6% of individuals have a Roth IRA over $100,000. I think there's huge misconceptions on this type of planning. I think there's total misunderstandings in regards to who qualifies. Should you convert, not to convert? How does this thing all work? Do you qualify or not? We'll break it all down for you. But for my help, in your help, let's bring in Big Al. 29%.
Just
has a Roth IRA.
29%. So would you say there's huge misconceptions?
I would say so.
Or huge misconceptions?
Huge. You know, I mean, but this is, there's a huge opportunity, I think, for people.
Yes.
A lot of times when we talk about Roth IRAs, it's like, well, they dismiss it. They're like, no, I don't qualify for it, or I don't understand it. You know, when they were going to come out with when they came out with the Roth IRA in 1997, they were going to call it the American Dream IRA.
Right.
I wish they did, because I guarantee you those stats would be different. Because when you hear of Roth, I mean, who wants a Roth? Right? It sounds like SARS. It sounds like an illness, right? I don't want anything to do with that.
Exactly. And the Roth is misunderstood, and that's why on this show we're going to talk about how to create a Roth IRA, different ways to get money into it, and some strategies to really kind of supercharge it to get a lot of money in it. So first of all, right off the bat, I guess we're going to talk about the basics. We got to start from the beginning because a lot of people are very confused on Roth IRAs. So let's go over the basics, who can do them, how much they can do. So we'll get into that first. Then we'll get into some contribution strategies. You're allowed to contribute to a Roth IRA based upon your earned income. And there's some limitations too. Now here's the big one, Roth conversions. This is where you actually convert some of your IRA 401k dollars to a Roth IRA. There's no limits there. Of course, you have to pay tax on it, but we'll go over things to consider there. And finally, some advanced strategies that I would say very few people are taking advantage of. So this is really the show for you to be able to have tax-free income and tax savings in retirement. And what a better topic for Sunday morning than tax-free income.
Well, I think with the Roth IRA, it takes the uncertainty of taxes right off the table, because every last dollar that you put in there is 100% tax-free. There's confusion. It's like, well, wait a minute. My earnings are still going to be taxed, but I get the principal out tax-free. No, if you put $5,000 into that account, it grows to $10,000, $20,000, $50,000, $100,000. I don't care what the number is. You pull that money out, it's 100% tax-free. There's some clarifications and qualifications to get that tax-free income, which we'll clarify today. But that is the key to today's show. Let's just kind of get into the basics, Big Al.
Yeah, let's start with that, Joe, because when it comes to the basics, the initial tax deduction in a Roth IRA is not deductible. As you said, not deductible at all, right? But the traditional IRA is sometimes deductible based upon your income level. Now, if you don't have a retirement plan or your spouse doesn't have a retirement plan, then it is deductible. In terms of being tax-free in retirement, here is the key. A Roth IRA is tax-free. A traditional IRA is not. You got to pay taxes on those dollars when the dollars come out. Maximum contribution in either case, Joe, is $5,500. Unless you're 50 and older, you can do an extra $1,000, so it would be $6,500.
So if you think of this, all right, so if you're going to save $5,500, do you want to take the tax deduction? You're in the 25% tax bracket, that's $1,200, roughly, give or take, right? But if I forego that $1,200 tax deduction, and then I save that $5,500 after tax into a Roth IRA, and that $5,500 grows to X amount, 100% of it's tax-free. But we'd like to get that instant gratification. Hey, I want the tax deduction today, and you know what, let's just kick it down the road. No, I want you to have a little bit more diversity when you're looking at your overall retirement planning, because I'm telling you this, when do you think you need the money the most? It's when you're in retirement. And if you have a pool of money that you can grab tax-free, that is a huge deal. So you have $5,500 into the Roth, you can go $5,500 into the IRA. Do you want to take the deduction or not? It's not as simple, it's not cut and dry. You know, you want to take a look at other factors here, but I think don't ignore the Roth is I think our point today.
I think so too, Joe. And if you look at some other factors, you need to have earned income to do a Roth contribution. And that's true whether it's a regular IRA, traditional Roth IRA, or traditional IRA versus a Roth. And there are income limitations. Certainly on a Roth, if you make too much money, you're not allowed to do a Roth contribution. When you're single, that starts at about $117,000. When you're married, that starts at about $186,000. When you're above that, Joe, you can't make a full Roth contribution, and then there's a phase-out period.
Yeah, but those are for contributions, right? But there is no income limitations for conversions, which we'll get into, which doesn't make any sense at all. So if I have $1 million in a retirement account, I can convert that to a Roth and pay the tax on it. The IRS is totally fine. Hey, well, we're going to get our tax money. But they're not going to allow me to put $5,500 into the account because my income's too high. It doesn't make any sense. So there's always ways around if you understand the tax law. So if you wanted to put $5,500 in, you can convert $6,500 from your traditional IRA to your Roth IRA, pay the tax. It has the same effect because a Roth IRA contribution is after tax. It will grow 100% tax-free. A lot of times, too, Al, they'll say, okay, well, I like the concept of tax-free, but how does it grow? I mean, what rate of return does this Roth IRA make, right? Well, the Roth IRA is just a shell. It's an account that you can open up at a mutual fund company, a discount brokerage firm, and then you can pick basically any investment that you like. You can pick a CD if you want FDIC insured, or maybe if you want an individual stock or bond, or, you know, we're big fans of mutual funds, exchange-traded funds, index fund type. Or if you want to get really crazy, you know, you can buy some real estate in there. You can buy gold and silver. That's Big Al's favorite, right? You got to get those gold nuggets. So it's not necessarily what the Roth itself makes. It's what you invest in, whatever that makes. So for instance, if I buy Apple stock inside my IRA and if I buy Apple stock inside the Roth IRA, and that Apple stock increases in value. If I pull it out of the Roth IRA, it's 100% tax-free, all right? Every ounce of growth, dividends, everything else is tax-free to me. If it's in the IRA, then 100% of it's going to come out to me as ordinary income. That's a big difference when you're looking at a diversified tax strategy long term.
It is a gigantic strategy. And Joe, I mean, we do get that question all the time on what the Roth does earn. And really, it does depend on the investment. So realize if you go to your bank and your bank just has CDs, that's the rate of return you're going to get. You might want to go to a discount brokerage firm that has stocks and bonds and mutual funds. If you want to invest in real estate and gold and silver, you have to go to a special kind of custodian that will handle that.
Yeah, well, if you want to buy like an apartment building or something like that, but that's another day, another show, and everything else. All right, hey, we got to take a short break. When we get back, we're going to dive into a little bit more complex strategies when it comes to tax-free planning for retirement. The Roth IRA, in my opinion, and Big Al's opinion, if I do say so myself, is the absolute best gift that the IRS has ever given us. So take advantage of it now. We'll be right back. Good morning, everyone. Hey, welcome back to the show. We're talking Roth IRAs today, one of the best investments you could possibly make in some instances because it gives you tax-free growth. We're going to get in the details here in a second, but before we do that, let's see how you did on the true false.
Your Roth IRA has to be open for at least 5 years before you can enjoy tax-free withdrawals on growth and income. And that's a true statement. To get your growth and income in a Roth IRA, you got to wait 5 years. It has to be seasoned 5 years. Interestingly enough, Joe, if you do a Roth contribution at any age, you can pull those dollars out right away. It's just the earnings have to wait. Earnings and interest have to wait 5 years. And if you're over 59 and a half, you can actually get your conversions out the next day as well.
Yeah, the 5-year clock gets a little bit confusing. We could probably spend a
does.
full show on
I
that.
think so.
Right. But yeah, I guess here's my word of advice. If you do not have a Roth IRA, I would consider starting one now. That would start your 5-year clock for all future contributions and conversions, potentially. So start it now. Get that 5-year clock going. So.
Yeah, I think that's good advice because you just do one 5-year clock, and so you want to start as soon as you can. In general, there are some exceptions.
Speaking of clocks.
But speaking of clocks, Joe, this is kind of, I don't know, I think our TV fans, by popular demand, they really like this, this countdown to retirement, which is where you get to answer a question in 60 seconds that you haven't even heard. Let's see how you do.
I can't wait.
Hey, Al. I have a question about required minimum distribution. I turned 70 and a half in January 7th. The year I turned 70 and a half, do I need to take 2 withdrawals? I do not want to take money out until after I turn 70 and a half. And how does that affect it?
He asked Al, right? So what he's referring to is a required beginning date, all right? A required beginning date. This is where it gets a little bit confusing when it comes to IRS. Right, you turn 70 and a half. You're mandated by law to start taking money out of your account at age 70 and a half. But your required beginning date actually doesn't happen until the year after you turn 70 and a half by April 1st. If you wait until the following year to take that required distribution, you have to take 2 distributions out to satisfy both years. That's how the law works. So the planning behind it is you have to take a look to say, all right, well, here, what is my income this year? What is my income going to be next year on my actual required beginning date? So if you feel that you're going to be in a lower tax bracket the following year, then that's when you take your RMD, but you have to take 2. Or you might want to spread it out between both years. Boom.
Perfect, Joseph. And that is correct. So you turned 70 and a half in the current year. Let's say in his case it was in January, and turning 70. 70 and a half would actually be in July, and so he could take his first required distribution that year. And then the following year he'd just have to take 1, or he could wait till April 1st of the following year to take his first one, but he'd have to take a second one. So let's go back into our Roth IRA discussion. And one of the things about Roth IRAs
you don't have an RMD.
is you don't. That's right. You don't have an RMD. But also earlier is better, Joe. When you start investing in a Roth IRA earlier, you can accumulate a lot more money. And I think we have an example. So the maximum amount is $5,500. It's starting at, and I just have an example, starting at age 25. And this would be $5,500 a year at 7%, retiring at 65. So 40 years, you have almost $1.1 million. Now, if you start at age 35, it's $520,000. At age 45, $225,000. And if you start at age 55, you only got 10 years to go. It would be about $76,000. And of course, we talk, and other financial planners talk all the time about investing early, and that's important. But Joe, sometimes even when you're 60 years old and you haven't even started, it's not too late.
It's never too late, right? As long as you can start saving, put things through the asset test, and start building up some wealth. Ideally, it would be great to build up tax-free wealth. Even a 55-year-old, you just saved the $5,500, right? That's almost $100,000 tax-free to you. So when you start taking distributions from your overall accounts, you might take a little bit from your retirement account, pay ordinary income tax, and then you can supplement some of the other income with tax-free accounts. Now, there's different contribution limits depending on what type of account that you have. The 401ks, are 18,000. The Roth IRA is 5,500 bucks. I would encourage everyone to take a look at their employer to see if they have a Roth provision in their 401k plan, because then you can really jumpstart this. If you're over 50, you could put up to $24,000 away into that account. As Al's playing with this iPad,
I'm getting good at it.
You're just killing it right now, buddy. Look at those circles. Is that $24,000 will grow 100% tax-free to you. Another very important component with a Roth 401k is that there is no income limitation, right? If you're making more than, let's say, $132,000 if you're single, or $194,000 if you're married, adjusted gross income, you're disqualified by doing a Roth IRA contribution. There is no income limitations to a Roth 401k. The Pension Protection Act of 2006 introduced this, so double check your employer. You might have it and you don't even know it, and you're missing a huge opportunity, Al.
Yeah, so let's switch now into conversions, Joe, because that's another way to get money into a Roth IRA. And this is where you take money out of your IRA 401k and convert it to a Roth IRA. And interestingly enough, there are no restrictions here. It can be any age. There's no income limitation, so it doesn't really matter what income level you're at. You can be working or retired, so you don't have to have earned income, and you can do any balance all the way up to your IRA full balance. So if you have an IRA worth a couple $1 million, you can actually convert that full $2 million. Now, you want to be careful in doing that, because then you'll pay taxes on $2 million. So that's probably not the right answer.
Right.
And usually, probably the best advice we can give is you want to look at this year by year. Maybe you convert a little bit each year based upon your tax brackets.
Right. It's taking a look at what tax bracket that you're in is going to determine how much that you convert, if any. So again, it's taking money that you already have saved, that you got the tax deduction, it's already growing tax deferred. There is no way around the tax here, right? So what our advice is to say, hey, maybe you take a little bit off the table. You take a little bit from that retirement account and chip away at that to get it into a Roth IRA. Because here's what we see is that most of you have all of your assets in this tax deferred account, which is great. You saved some money. You did what you were told. But 100% of these dollars that will come out to you as a form of income is going to be taxed at ordinary income rates. These dollars up here, folks, it's 100% tax free. So that's why we like to have a little bit more diversity when it comes to your income strategy. Have a little bit of tax deferred, a little bit, well, a lot of tax deferred, a lot of tax free, and a lot of taxable would be ideal. But if you have everything just jammed up in your tax deferred accounts, your 401ks, IRAs, 403bs, just know if you're trying to replicate your paycheck in retirement, those dollars that come out of that retirement account is taxed exactly the same way besides FICA tax. But now if I can have different areas to pull from, Al, it makes a huge difference. It stretches those dollars out because you're paying less tax over the long term.
That's exactly right. And a lot of people don't realize when you do a Roth conversion, all future growth, income, and principal is 100% tax-free. And if you were to pass away, your spouse would receive it tax-free. And if the two of you pass away, your kids or grandkids get it tax-free. So the tax-free nature of this account keeps the same. It doesn't change. But I do want to get into an example here where somebody who just retired, let's say age 65 and spouse is age 63, and let's just say there's no income other than some investment income of $20,000, and that's my baseline scenario. The deductions, exemptions, $20,000. So taxable income is zero. There's no taxes to be paid in that year. You think, well, this is pretty good. But what happens at age 70 and a half is you get Social Security, your required minimum distributions. You're in a much higher bracket. Here's a smarter thing for this couple is maybe do a Roth conversion of $150,000. They end up with $150,000 of taxable income. That, by the way, is the top of the 25% tax bracket. Now you got some tax diversification because you hit age 70 and a half, and several of those dollars are going to come out tax-free, Joe. And that really is the key. It's controlling your taxes all the way throughout your retirement.
With that example, it gets a little confusing because Al's an accountant, right? He's just looking at the income on the tax return, not necessarily cash flow. Because this is saying, well, if I'm looking at this, right, a non-accountant, and say, well, Al, I got to live, right? I do all these conversions, I pay the tax. How am I going to live my day-to-day activities? We're talking just what's showing up on your tax return. Because if you take a look, most of you, most individuals will take, let's say if you have cash, you'll start depleting your cash, right? There's no taxation if you're just taking money from your checking or savings account and depleting that cash account. Or you might have a brokerage account that you're selling assets there to provide that income. So very little income shows up on the tax return. We see this time and time again. It's a huge opportunity wasted. I mean, we went to the 25% tax bracket. You could go to the 10% bracket, the 15 or 25 or even higher. It really depends on how much money that you have in your overall retirement accounts. What's the effect of your required distributions? How much money do you want to maintain as a lifestyle? What's your overall goals when it comes to passing your wealth? So there's all sorts of different things that you have to look at. We're just scratching the surface here, but the goal of this TV show is to help inform you to say, you know what, there's other things out there that could really benefit me if I just knew it. And if I, if you hear the noise, sometimes you get kind of bogged up a little bit and you don't take action. So, hey, we got to take another break. When we get back, we're going to get into a little bit more advanced strategies when it comes to Roth IRA conversions. And then guess what? We're going to flip the show back to you and we're going to answer your email questions. So don't go anywhere, folks. Show's called Your Money or Wealth. Hey, welcome back to the show. Show's called Your Money or Wealth. Joe Anderson and Alan Clopine. Big Al, we like to call him. Hey, we're talking Roth IRAs. Got another quick tip before we go today, and then we're going to answer your email questions. But I know you're all waiting for the true-false question. Let's see how you did.
You can contribute to a Roth IRA for a given tax year as late as April 15th of the following year. Joe, that is a true statement. You can. It's one of the few things you can do after year end and still have it pertain to last tax year.
Yeah, April 15th. So depending on what date it is, you have April 15th of the following year after the calendar year. Note this, though. If you want to do a Roth conversion, which we talked about, that's taking money from your retirement accounts into a Roth IRA, that has to be done in the calendar year. So you have until 12/31 to get that Roth IRA conversion done, but you have until April 15th of the following year to make sure that you get that Roth contribution in. But here's the confusing part, but also the best part, is that you have to get that conversion done before the calendar year. And so you want to make sure that you know what tax bracket that you're in, but you don't know what tax bracket you're in until the following year, until you do your taxes. So what kind of mess is this? Well, if you take a look, any dollar that you put into a Roth IRA, you could recharacterize it back into the IRA like it never happened. For instance, I have a money in I have $100,000 in my IRA. I convert $25,000 of that to a Roth IRA. And then I do my taxes next April. And then I realize it's like, you know what? I didn't want to do $25,000. That was way too much. I don't want to pay that tax. I only want to do $10,000. Well, then you can recharacterize $15,000 back into the IRA like it never happened. It's an undo. You can undo the whole thing if you choose to. So you could get fairly aggressive with this strategy. You could get aggressive from a standpoint of looking at expected rates of return, not from a tax standpoint. Big Al's looking over my shoulder here. Oh, but there's all sorts of different strategies that you can do to really maximize this. So, Alan, recharacterization, it's one of the only redos or undos that you can do in any type of strategy when it comes to taxes.
It's true, and it's which is why we recommend when you do a Roth conversion, you do that at the beginning of the year, let's say in January, February, March, because that money grows tax-free longer instead of waiting till December 31st, and you have all the way up until April 15th of the following year to recharacterize, or October 15th if you actually extend your tax return. So it's a great deal. Sometimes people do more than one Roth conversion, invest them differently, keep the one that does better, and put the one that doesn't do as well back. Now we're getting really advanced, but you can do some really neat things with your Roth conversions.
All right, we got about a minute and a half left. Let's see how many emails we can jam in this minute.
All right, the first one, Lucy, San Marcos. I want my children to inherit my Roth IRA. I'm 73 years old. Can I transfer the funds to them while I'm alive without increasing their tax burden? Well, Lucy, first of all, you can't transfer your retirement account. It's your retirement account. That doesn't transfer until you pass away under the beneficiary statement. So no, you're not allowed to do that. But secondly, when your kids or grandkids, whoever gets this Roth IRA, get it, it's tax-free to them too. It was tax-free to you, it's tax-free to them as well.
Yeah, there is no required distribution, Lucy, so let that continue to grow tax-free. And then when you pass away, it goes to them, 100% tax-free. Let's try to get one more in.
Mike Coronado, can I receive a tax benefit for volunteering my time as a judge? So I guess Mike is a fine judge in San Diego.
And the
answer,
a judge
Mike,
on The Voice?
Maybe it could be. The answer is
American
no. Unfortunately, your time, it doesn't. You can't deduct your time. So yes, you are volunteering, but the flip side is you don't have to pay taxes because you didn't receive any income from volunteering. So the
that's
answer,
a plus.
The
right?
answer.
So you're volunteering your time. You're not getting paid. So you're not getting compensation. So you're not paying tax on it.
Yeah, but that's
but you can't deduct
how
your
the
time.
IRS looks at it.
All right. Well, hey, folks, there's still time. Please take a look at a Roth IRA. It will make sense for some, but not all. But look at the stats. Only 30% of people are using this strategy. Don't be part of a statistic. We'll see you next week. Have a great weekend, everyone. Great job, Big Al.